Good evening, sir.
Sorry, I've been trying to join the class.
Good evening, sir.
Yeah. All right, please, can we mute? Let's check our speaker that is muted. Our class tonight, we shall be rounding up on the first topic we started. That is capital structure and theories of gearing. We should be rounding up on this topic tonight. Let's take a recap of our last class for 10 minutes. We try to explain what is capital structure. First, we started by defining what is capital. Capital is the money you use to create a business, the money used to build a business, and the money used to run a business. Money used to create, build, and run a business is what we call capital. All business organizations require capital. We look at the types of capital: equity capital and debt capital. Thereafter, we explain what is capital structure. Capital structure of a company shows the different types of capital a company uses in carrying out its activities. When we say capital structure of a company, it shows the different combination of capital a company uses to carry out its business. It may include ordinary share capital, preference share capital, long-term borrowing in the form of debentures, and you can have short-term capital, short-term debt capital, such as bank overdraft and trade credits. We explained this. We now said a company can choose to finance its business with equity capital only. Where a company uses equity capital only in its capital structure, we refer to such company as ungeared. Alternatively, a company may be financed by a combination of equity and debt capital. Such company will be regarded as geared company, where your company is financed by equity and debt. We now discuss risk. We explain risk as volatility in your return, volatility in business return, or fluctuation in business return. Or variability in return. We explain this. We explain the two types of risk. Risk can be classified into business risk and financial risk. We said business risk has to do with the nature of your business. Business risk has to do with the nature of your business. It is the risk that a company may suffer losses, or a company may achieve low profits due to the nature of the company's business. And we now say to measure business risk, you can use operational gearing. Operational gearing can be used to measure business risk. We explain the different methods of calculating operational gearing. We now look at financial risk. Financial risk is the additional risk to investor, additional risk to shareholders that arises because the capital structure contains elements of debt finance. Additional risk to shareholders because the company has borrowed money to finance its business. In other words, financial risk arises due to debt finance. Financial risk is purely associated with debt capital. We explain this. We now say to measure financial risk, you can use financial gearing, you can use interest cover ratio, you can use debt ratio. Any of these ratios can be used to measure financial risk. Thereafter, we look at question number 1. Last week, that was question on airpiece. We now give an assignment of question number 3 as an assignment. Only few students submitted their assignments, which is quite worrisome. The assignment is to monitor your level of understanding. It helps the lecturer to know which areas that require further consideration. So please, you are encouraged to try and attempt assignments. Tonight, we shall be looking at that assignment together in the classroom. Please, let's go to page 77 of our study pack. Question number 3. Yeah, this is the question. Baswani and Co. Limit, Baswani and Company. Please, let us go to page 77/78. If I'm not mistaken. Question number 3. Please, can somebody confirm that that page is correct so that we can start with this question?
Hello, sir. It's on page 151.
Oh, thank you. Oh, page 151. That's my error. I have other classes. Please check page 151, question number 3. For those joining the class for the first time tonight, you have not missed much. This question will also explain what we solved last week. At the same time, please request for the videos of previous classes so that you can keep yourself abreast of what has happened while you were not on the platform. All right, I will go with the question. Baswani and Co. is planning to invest in new machinery costing 10 million naira. The revenue and cost arising from the new investment as follows. The new investment will generate sales figure, variable cost of sales, other variable operating expenses, other fees operating expenses, including allowable depreciation. The purchase of the machinery will be financed solely by an issue of 7% bond repayable 2019. Now look at that statement. The company wants to buy a machinery costing 10 million. This machinery purchase will be financed solely by an issue of 7% bond. A bond is a debt instrument. For some reasons best known to them, some students were looking at, when solving the question, they were giving me debt finance, equity financing. Please treat all questions independently. The fact that the first question we solved, it includes debt and equity financing, does not mean all questions will include debt and equity financing. Treat all questions independently. All right? The third paragraph. Vaswani budgeted statement of profit or loss for the year ended and statement of financial position as at 31st December 2014 before taking into account the effects of the new investment as follows. We have the sales figure, cost of sales 100% variable. Then we are giving the gross profits. Other variable expenses, in brackets 50% variable. What that means is that if 50% of this cost is variable, then the balance of 50% will be fees. We have the gross profits, the interest rates, profit before tax rate 30%. We have the profit after tax. Then we have the dividend, in bracket dividend cover, constant 2:1. That means ratio of profit after tax to dividend is ratio 2:1. Then we have the retained earnings. This information is before the new investment. Statement of financial position. You have the non-current assets. You have the current assets. We have the total assets. Then we have equity share capital and reserves. We have 10% bond to mature 2018. It was 8 million. Then we have current liability. If you look at this statement of financial position, this company is financed by equity and debt. Look at it. This is the equity share capital, and we have 10% bond. A bond is a debt. So this company, Baswani & Co., is financed by a combination of equity and debt capital. Hence, this company is a geared company. Show the effects of the new investments on operational gearing, interest coverage ratio, and financial gearing. Last week, I had a student that solved this question. She scored 19/20. That's quite impressive. Now let's go to this question together. The first thing is you need to adjust the statement you are giving. Before you can compute operational gearing, interest cover ratio, financial gearing, let us go to adjustment. All right. To pick my pen. I'm trying to pick my pen. Line. Let's hold on. To navigate and go to my pen. It should give me way to my pen now. All right. Now, please, what is the sales value currently? Look at it. I have current position. I have adjustments. I have revised position. Now, please come. What is the sales value currently?
That's 16 million. That's 16,000.
16,000.
Thank you. The sales value is 16,000. Because of new investments, we are going to have 2,500 sales more. Is that not?
Yes, sir.
Hello.
Yes, sir. We are going to have 2,500.
Now, revise 16 plus 2,500. What do you have here?
That will be 18,500.
18,500.
18,500. Please be involved in the classroom. Examiner says variable cost of sales, 100% variable. Please, what is the cost of sales currently?
9,600.
9,600. Because of the new investment, what is the variable cost again? Variable cost of sales?
1,100.
1,100. Add the two together. Revise variable cost of sales.
10,700.
10,700. Next. Now remember that you are going to require contribution later. So plan for it now. Pick all your variable costs first before coming to fixed costs. Look at the question. Examiner says variable operating expenses is 50%. Is that not?
Yes, sir.
Yes, sir.
Now please compute 50% of 2,800.
1,400.
1,400.
1,400 is variable. Then also remember, the fees is also 1,400. Now
Yes.
check the new investment. What is variable operating expenses?
200.
200 naira.
200. Sum up. We have
1,600.
1,600. Now you can get your contribution. Contribution is sales less variable cost. 16,000 minus 9,600 minus 1,400. Please get.
5,000.
Thank you. You need to plan your journey from the beginning. Contribution here is 5,000. If you like, you can do the adjustments. If you like, you can ignore it. What matter is current position and revised. But let's do it. What do we have here?
1, 2.
We have 1, 2. Then what do we have here?
6,200.
Good. We have picked our 6. We have picked all our variable costs. Now we move to fixed cost. What is fixed operating expenses currently?
1,400.
1,400. 50%.
Yeah, of 2,800.
50%. Don't forget. 50%. Examiner says operating expenses, other operating expenses, 50% variable, 50% fixed.
50% fixed.
Thank you. So you must quickly interpret that. Any adjustment for variable operating expenses?
120.
120.
120. Now add 14 plus 120. 1520.
1,520. Yes.
Excuse me, sir.
Now you can get your profit before interest and tax. 5,000 minus 14.
3,600.
This gives us 3,600.
The second one is 1,080 naira.
1,080 naira.
1,080.
And
Difference, what do you have here?
4,680.
6, 8. What is the interest currently?
800.
800. Okay. Now, the question says the purchase of machinery will be financed by a 7% bond. Is that not?
Mm-hmm.
Yes, sir.
Yes.
Yes.
Let's go to it.
700.
Thank you. We require 10 million to purchase a machinery. We are going to borrow 10 million. The interest is 7%. Please compute 7% of 10 million.
Oh.
What is the new interest?
700.
700,000.
Thank you. The interest should be in brackets. This 800. So we are going to have 700. That means revise 800 plus 700. It becomes 1,500. Interest on the existing debt and the new debt. You cannot get your profits before tax.
2,800.
How much?
2,800.
Oh, 2,800. Difference there, how much?
380.
380. Difference
And
there, how much?
3,180. 3,180.
3,180. Compute your tax. 30% of the profit before tax.
For the last one,
840. First one. First
For
one,
the last
840.
one,
954.
954. Thank you. What do you have here?
840. First one, 840.
840.
114.
If you like, you can tax this. How much?
114.
114.
114. You can now get your profit after tax.
Oh. Oh, boy.
Oh boy.
1,960 for the first one.
Sorry. The first one?
1,960.
Second one, 260.
1,960.
266 for the second one.
Yeah?
2. Okay.
Yes.
66.
Something like
The
this.
second one, 266.
That
Oh,
last one is correct.
266.
Yeah, the last one is correct.
266. Yeah, last one is correct. Yeah?
All right. Examiner says dividend cover ratio 2:1. It means that profit after tax is 2 times dividend. It means that, please, can you mute? Thank you. When the examiner says dividend cover ratio is ratio 2:1, that means the profit after tax is twice dividend. It also means that dividend is half of profit. Hello? Examiner say dividend cover ratio 2:1. What is dividend cover ratio? The number of times the company's profit after tax cover dividend payment. Ratio 2 to 1 means that profit after tax covers dividend payment 2 times. So you can compute half of 1,960.
980.
980.
Sorry, are we doing exact divide
133.
by?
Yeah, assure you, sir. How did you get a 980? Kindly.
Yeah.
And that's what I said now. Okay, let's do like this.
Excuse me,
Yeah.
sir.
Yes.
Please, sir, I need to draw you back, sir. 50% of how you get 120. I'm trying to look at it. I'm trying to calculate.
120
Yes. Yes, sir.
is in the question. Do you have the question with you?
Yes, I'm scrolling. Okay. The other fixed
Go
operating
to the
expenses.
question
Yes,
where you have new investment.
Yes, I've seen it, sir. Thank you, sir. Thank you, sir. I've seen it, sir.
All right. Okay. Let us do this dividend cover first. Or let me do it near itself. Let me find the way here. Okay, let me create a space here. Yes, Victor.
Good evening, sir. So, I am trying to understand why we are
Yeah, good evening.
I'm trying to understand why we are considering the 120.
Why
Considering
we
the
are
fact that we
considering
said
what?
why we are considering 120, because I remember in last class you said taxes and interest are not to be looked at, that we only look at things that we have control over in our business. So
Okay.
tax this doesn't need to relate to tax, other fixed operating expense, including tax allowable depreciation.
Okay. He said he's trying to consider, he's trying to find the reason for why we consider 120. Please, what is this 120? This 120 is fixed operating expenses, including allowable tax depreciation. Tax depreciation is not taxation. That is the first point. Tax depreciation is what we call capital allowance. That is depreciation recognized by government. Accounting depreciation is not recognized by government. Government only recognize tax depreciation. This is not taxation payments. That is the first point. Second point is you have incurred fixed operating expenses of 120 by taking a new investment. You have incurred additional fixed operating expenses of 120 as a result of the new investment. Before the investment, your fixed operating expenses was 1,400. You now engage in a new investment. As a result of the new investment, you incurred another fixed operating expenses. That means the one you have incurred before and the one you incurred on the project, on the new investment, we add the two together. That is what we have done there. Now, the second aspect I want to also correct. I said when we are dealing with the ratio, we have not even got into the ratio. When we are computing operating gearing, I said we don't consider fixed costs and taxation. In this place, we have not started the computation of operational gearing. I hope it's better, please. Victor,
Yes,
I hope it's
thank you.
better. Because no,
Yes, thank you.
that's why we always pray that they don't misquote you out of content. All right, let's go on. Now, the first question was, how do we get this 980? Examiner say dividend, in bracket, dividend cover ratio. Now, what is dividend cover ratio? 2 to 1. Your dividend cover ratio is calculated as profit after tax divided by dividend. Examiner say this is 2 to 1. That means profit is 2 times dividends. If I now want to get out of this profit, I want to get dividends, I will just do like this. My dividend is half of my profits. I'll simply do like this, 1 over 2 multiplied by 960. That will give you 980. You observe that this profit is 2 times dividends. If you want to get for 266, it becomes half of this now. Let me create more space.
Actually, sir.
Yes, sir.
Sorry
Please go ahead.
Is it possible to use this shortcut? Because with what you just did now, I think if you divide this 1960 by 2, we have this 980. The same thing goes for this 266.
And that's it now.
Oh.
You just divide by 2 now.
Just divide by 2. Okay. Instead of using 1 over 2.
That's what we have done now. Half of it is divided by 2 now. It's not half. If I want to get for adjustments, I'll just do like this now. 1 over 2 divided by 62. That will give me what?
133.
33.
Yes, I just.
If I want to do for this now, half of 2226.
That will be 333.
1 1 1 3. Then my retained earnings here. 980 133 1113. You are done with your statement now. You have adjusted the statement with the new investment. Is that clear? Please, I can assure you that by God's mercy, you can score 80 above in this course. Just as much as possible, keep to instruction. Yes, Ogechi.
Yeah, so I just wanted to ask, following this table in preparing our statements, is it constant? Will it always be like this, or there are going to be tweaks or changes? Or
it could change. It could change. The table can change. What will not change is the principle. So, in summary, do not attempt to cram the table. Just understand the principle. You want to calculate operational gearing, and there's an adjustment to be made. Examiner gave you adjustment in sales, adjustments in cost of sales, adjustments in fixed operating costs, adjustments in interest. So apply all the adjustments. All right. We have adjusted the statement of the statement of profit and loss.
Excuse me, sir.
It's equally important to adjust your statement of financial position. Yes, sir. Please go ahead.
All right, so what I want to ask here is that the adjustment we are doing, is it based on what they gave us?
Yes, we are waiting. Say, excuse me.
Can you hear me? Hello, hello, sir.
I'm trying to understand the question.
Yes, so I think the network went off. Can you hear me now, sir?
What they gave us.
Okay, I wanted to know if you are just adjusting this sales variable, other variable. Okay, we are not, after that, we don't have any other thing to do with the statement of financial position, or we still have to work on it.
You said what we are doing, is it based on what they gave us? Is that your question?
Like something
So
like that. Is it just
can you restate your?
Hello, can you hear me, sir? Good evening, sir. Can you hear me, sir?
The first question is the adjustment based on what they gave us. Yes. Examiner says it appears.
The network is fluctuating.
Yeah, I think so. I'm not even hearing
I'm
anything.
back.
Okay, welcome back, sir.
All right, please, can we go on and let me hear what you are saying, please?
All right, sir. Thank you for the audience. What I'm just asking, the first table they gave us that contains sales, variable cost of sales, other variable operating expenses, other fixed operating expenses. Is that the only table we are adjusting, or we are adjusting this statement of financial position with the first one they gave us?
Of course. Okay, okay, thank you. Your adjustment is based on what you want to compute. You need to plan ahead. Now, if you look at the requirements, let me go back to the requirement. Yeah, Ishola, please hold on. Ishola, please hold on. Look at the requirements. Show the effect of the new investment on operational gearing. Now, let me ask you, If you want to compute operational gearing, what is your formula?
Fixed cost over total cost.
Hello, guys.
Can you hear me, sir?
If you want to calculate operational gearing, what is the formula?
That's what I just said now. Fixed cost
Good.
over total
That
cost.
means, where will your fixed cost come from? Yes, fixed cost over total cost. Very correct. And I ask again, still, where will your fixed cost? Where are you going to pick your fixed cost? Which of the statements?
I think statement of profit or loss for the year
Hello?
ended.
If you want to pick your fixed cost, which of the statements will show you the fixed cost?
Statement of profit or loss.
Thank you. Your statement of profit and loss will show you the fixed cost and total cost. That means you need to adjust that statement.
Okay.
You need to adjust that statement with the new investments.
Okay.
Now, if you want to compute interest cover ratio, what's the formula?
Profit before interest and tax, then the interest expenses.
Good. Where will these two items come from?
The same statement of profit or loss.
Good. You see it now? That means I need to adjust my statement of profit and loss to include the new investment, because I want to show the effect of the new investment.
Okay.
Now, the third one, financial gearing. What is the formula for financial gearing?
The prior charge capital over equity, including reserve. I think so.
Equity funds. Thank you.
Yeah.
Now, these two items you have mentioned, where will you get it from?
Statement of financial.
Hello?
Statement of financial
position. That means you need to adjust that statement too now with the effect of the new investments. Is it clear, please?
Yes, clear now, sir. So, sir, in nutshell, what we are solving will depend on what we are adjusting.
Of course, your adjustment is informed by the requirements.
By the requirement, correct? Yes. Okay. Thank you, sir. Now I get it. Thank you, sir.
Hello, sir. Good evening, sir.
Okay, yes.
Sorry for drawing. I have a question. As regards that tax, when you were adjusting that tax under the adjustment column, how did you get 114?
Okay, apply tax rate 30% of 380.
Hello, sir, Mr. Asiwaju.
Yes, Abaka.
Thank you, sir. Please, this dividend cover ratio, what if you have something like 3:1 or 3 or 4:1?
It's not a problem now. Examiners say dividend cover ratio is 3:1. That means the profit is 3 times the dividends. In that case, if you want to get dividends, just divide it by 3. Now divide the profit by 3.
Okay. Thank you, sir.
If the examiner say 4:1, that means the profit is 4 times dividend. If you want to get dividend, take the profit after that, divide it by 4. It's just mathematics now.
All right, thank you, sir.
You're welcome, please. All right. Now I need to adjust these statements. Of course, the aspect I want to adjust is the aspect of the capital side. I'm less bothered about the asset side. Currently, we have $10 bond maturing 2018. The value is 8,000. Is that not, please?
Please proceed, sir.
Yes.
Correct. Also, under revise is still there, 8,000. We now have new bond. Examiner said the project will be financed, the investment will be financed solely by 7% bond. It will not appear here. It will come here under revise. That means total long-term debt. Currently, the debt is 8,000. Revised, because of the new project, we are going to borrow 10 million more. It becomes 18 million. I hope this point is clear.
Sorry, sir, it's not clear to me.
Hello?
How did we get 10,000, sir? The
It's not clear
10,000.
to me.
Please, let's try to follow the question. No, asking me how we get 10,000. Okay, let's go to it. The project is to be financed. Let me go back to that aspect. Okay? Please look here. Vaswani is planning to invest in new machinery costing 10 million. Now come here. The purchase of the machinery will be financed solely by an issue of 7% bond. That means we are going to borrow 10 million naira by issuing 7% bond to finance the purchase of the machinery. We have 30 up. That is where the 10,000 is coming from. Now look at this also. Under the current position, the bond is 8,000. That is 8 million. We now finance a new investment by taking additional bond of 10 million. That means under revise, we are going to have two debts. The existing debt and the new debt. The existing debt is 8 million. The new debt is 10 million. Is it getting better, please?
Yes, sir.
Sorry,
please.
Sir, what about that 7%? Sorry, sir, that 7%.
Okay, what about it?
I don't understand its application. How did you use it at all?
Assuming there is cane, I will just come and cane you. That 7%
my network has
is
been
the
fluctuating.
wait now. That 7% is the interest that we go to the profit and loss statement.
Okay.
And now when you prepare accounts,
okay.
Look at it now. Look at it. Look at that 7%. That was the interest we computed here. 7% of 10 million. The interest is an income item. Is that better, please?
Yes, sir.
It should not fluctuate again. No. Like, online class, it's more demanding than physical class. You exert more energy on the online class. But it's okay. So can you see now? Look at under current position. We have just 10% bond, 8,000. It's still, after revise, it's still there. Under 7% bond, that is, we are going to take 10 million. That means currently the debt is 8 million. Under revise is 18 million. But we have 30 up. Now you come here. Our share capital and reserve currently is 24 million. You now add the adjustment to it. What is the adjustment to reserves?
Retain
And look
earnings.
at it now.
Retain earnings.
What is the adjustment? How much?
4 million.
How do we get what?
980.
How did you get 24 million?
Okay, are you with the question? Look at, are you with the question?
Okay, sir. I've
Okay,
seen
let
it.
me read. It's good. So, but you can, it's okay the way you ask, because the intent is to try as much as possible to make the student to understand this. All right. Now, under revise, we need to adjust that 24 million with the adjustment. What is the adjustment now? Please, the adjustment is the addition to retained earnings is 133, not 1,130. The adjustment to your retained earnings, that means this 24,000 will increase by the adjustment. If you come here now, because of the new investments, additional retained earnings of 133 was generated. That means the share capital and reserve will increase to 24,133. I hope this point is clear to all.
Yes, sir.
All right. Polite. You can speak.
Please, sir. This figure 24,133. I will suggest you do workings for it, so as for reference purpose, when going through, we can know
I was thinking
you
so
derive this
too.
number.
I was thinking so too. Let me do like this. Permit me to do something quickly. I'm feeling so too that, okay. Thank you, Polite. Because,
All right, sir.
let me see if I can do something within. That's why they always say that nobody owns a monopoly of knowledge. Let me see if I can do something so that the same way you have it up, I'm trying to see if I can do something similar to that. Hold on. Let me move this a bit. Let me move this a bit. No, it's okay. I want to move it a bit. What happened? Okay. Don't go and scatter the whole system for me. I'll just. I want to introduce one line here. Okay. Under current position, I'll take this as adjustments. I have 8,000 adjusted by 10,000 new bond. Revise is 18,000. So I'll ignore this here. Let this one go. I have total for this. This is 8,000. 10,000 new debt. Total 18,000. I have 24,000 here. For adjustment, I'll close this. 133. So I'll close this also. I have 24,133. I've taken this out. I hope this helps us. Now you can now go to the requirement proper now. No, we have not solved the requirements. We have just done adjustments. We can go to the requirement proper now. Examiner says calculate operational gearing. Your operational gearing under current position and revised position. You can calculate as total fixed cost divided by total variable cost. Let's go to the adjustment, to the table, the statement. My total fixed cost. Look at fixed cost here. 1,400. Look at fixed cost here. 1,520. Pick it. Keep it. Total variable cost. Our variable cost. 9,600 plus 14,000. How much, please? That should be 11,000. Variable cost here. 10,700 plus 1,600.
Sir.
That's 12,300.
That's 12,300.
Thank you. So, yes, somebody says, sir.
No. I thought you mentioned under this other variable operating expenses. I thought you mentioned 14,000 naira. So I wanted to call your attention to it. That it's not
No, I
14,
said
it's
1.4.
4,000. 1.4. All right, sir.
All right, thank you. You can go back now. All the figure we require is already completed. Just to be picking your figure. I just come here. Currently, this is 1,400. This is 1,500. This is 11,000. This is 12,300. Please compute fixed cost divided by variable cost multiplied by 100. What is the operational gearing? So that we can round up on time.
12.7 for the
What do you have?
current. 12.7 for current.
No,
The current 12.7%. What do you have
the other
here?
one 12.35.
12.34 approximately.
Yes.
Yeah.
Once you are maintaining 1 decimal point, you have to be consistent. 12.7, 12.4. What has happened to the business risk?
You do get that variable cost.
Has reduced.
How do you get that total variable cost, sir?
Okay, if you have the solution with you, check addition of our variable cost. Okay, look at it again. Please, let's try to follow. Look at it. Variable cost of sales, 9,600. Let me take this away from here, because I was moving the line. Variable cost of sales, 96. Other variable operating expenses, 14. Please sum up. 96 plus 14.
11,000.
Also check here. Thank you. Now look at the second formula. You can also calculate using contribution divided by profit before interest and tax. Either of the formula can be used, or the third one can come here. What's the contribution? Under revised, contribution is 5,000. Sorry, under current, 5,000, revised 6,2. What is profit before tax? 3,6.
2,8.
4,000.
You said profit before tax, sir, not profit before interest and tax.
Sorry, profit before interest and tax. So
3,600.
4,680. I can return here. Contribution here is 5,000. Here 6,200. Here I have 3,600. Here I have 4,680. You don't need to multiply by percentage here. Okay. Divide your contribution by PBIT. This is 1 point what?
For the revised, 1.3.
1.3. This is what here?
1.3 or so. 1.4, yeah. Approximate.
1.4. Of course, you won't get the same figure, but your comments will be the same. Whether you use the first formula or the second formula, we observe that because of the new project, the business risk of this company has reduced slightly. Because of the new projects, there's a reduction in the business risk of Vaswani and Co. In exam, you don't need to show the formula. Just use 1 or highest use 2. We have shown the 3 formula you can use.
Sorry, did you say 3? I think it's 2. I think it's just 2 that I saw here.
And you are just joining the class today?
And this is my second class.
Were you in my class last week?
Yes, I was.
If you check, that means if you check that last week, we used 3 formula.
Yes, sir.
If you look at last week's solution, we used 3 formula in computing operational gearing. And please, another thing is, please try to review your material. Do not accumulate your notes. The third formula is total fixed cost divided by total cost. The third approach is you can also calculate operational gearing as you can calculate operational gearing as your total fixed cost divided by total cost multiplied by 100. If I want to show that now, because if I want to show that here, you show under currents. You have the current position. You have the revised position. Our total fixed cost. This is 1,400. This is 1,520. Then our total cost. Your total cost is the addition of total variable cost and total fixed cost. You don't need to go start computing again. Your total cost, summation of your variable cost and fixed cost. Go to the first computation. Look at it, please. Total fixed cost, 1,400. Total variable cost, 11,000. Sum the two together.
12,004.
12,004.
That will give me 1,200 under current. Go to revise. Sum the two together.
13,820.
I can go down and compute. First one, we have total cost 12,400. 13 what, please? 13.
820.
820. You can compute your operational gearing now. Here you multiply by percentage. 1,400 divided by 12,400. Multiply by 100. 11.3%. 1,520 divided by 13,820. Multiply by 100.
Is 11% approximate.
10 point something, maybe 10.9.
10.9.
Yeah, 10.99.
10.99.
Can you see it? Note, because total cost is equal to total fees cost plus total variable cost. This was where I made a statement that when computing your total cost, you don't need to include taxation and interest. In computing your total cost, you don't include interest. Interest is also a cost. Taxation is also a cost. But we don't include these two variables because they are regarded as items not within the control of the business. Government determines tax rates. Tax rates is not within the control of the company. Interest rate is determined by the lender. These costs are regarded as non-controllability costs, not within the direct influence of the management. Again, we have shown the three methods. In exam, if you are required to calculate operational gearing, the examiner can specify any of these methods to you. Or the examiner may remain silent. You can use any of the formula. All right, so may God give us a better understanding. Next. Okay, here's your question.
Okay, sir. Sorry to bother you. I just want to reiterate. If we are using the fixed costs over variable costs, we are going to be multiplying by percentage. Same goes to the total cost, total fixed cost over total cost. While if we are using the contribution of our PBIT, that one we don't need to multiply by percentage, right?
Yes, please. Yes.
Okay. Thank you.
It shows number of times. It's calculated in times. All right. Next is interest cover ratio. Your interest cover ratio is calculated as profit before interest and tax divided by the interest expense. Our PBIT year 36. Year 4680. Expense year 800. Expense year 15. Please compute your interest cover ratio. Please don't multiply by 100. This is number is times.
4.5 for current.
4.5 times.
And 3.12 for revised.
3.12
for revised.
12. If this ratio is falling, it's not a good sign. If your interest cover ratio falls, it shows that the company is not having enough profit to cover interest expense. Then the last computation. Financial gearing. You can calculate as prior charge capital divided by equity funds. Recall, prior charge capital is equal to long-term debt plus preference share capital. preference share capital. In this question, there is no preference share capital. That means you only pick your long-term debt. If you go back to the revise here, long-term debt here is 8,000. Look at the total long-term debt, 8,000 here, 18,000 here. Shareholders fund, 24,000 here, 24,133 here. You can compute. This is 8,000 prior charge capital. This is 18,000. Here I have 24,000. I have 24,133. Calculate financial gain. 8,000 divided by 24,000 multiplied by 100. 33.3%. 18,000 divided by 24,133 multiplied by 100.
75% approximate. 74.6.
74.6.
74.6.
Yeah.
Financial gain has increased. Increase in your financial gain means increase in financial risk. The financial risk of the company has increased. You are done with the computation.
Question, sir.
Yes, please go ahead.
You mentioned earlier that the question didn't carry anything about preference share capital. Is it safe to just use the normal ordinary share capital that was mentioned there?
I didn't get that, sorry.
When you're about solving this financial gearing, you said the question did not carry preference share capital, but we use the share capital in the question that was provided. I don't know if it is safe like that or it has to be written preference share capital before we can use it for solving financial gearing.
Honestly, I'm trying to pick your statement.
Okay, is it better now?
Okay, let me hear you.
Okay, I was saying that before you attempted this financial gearing, you mentioned that the question didn't carry preference share capital, but we used the ordinary share capital in there. So I was just asking if it is safe to use just the ordinary share capital or the preference share has to be mentioned before we can use it in solving this financial gearing.
Okay. First is, I mentioned preference share as part of prior charge capital. Your prior charge capital is the summation of long-term debt plus preference share capital. Assuming you have preference share capital in this question, you are going to treat it as part of debt capital. That will form part of your preference share capital. That is the long-term debt plus preference share capital. That is the first thing. Your prior charge capital is the summation of long-term debt plus preference share capital. I now said, for this question specifically, we don't have preference share capital. That means our preference share capital will be 0 here. Hence, you only pick your long-term debt, which is 8,000. You only pick that. Now, you now mention something that, is it safe to go and pick equity share? There is no relationship here with what I explained. To calculate gearing, the formula is prior charge capital divided by equity funds. Equity funds is ordinary share capital plus reserves.
Thank you, sir. I missed that part. Thank you.
Yes, prior charge capital does not include ordinary share capital. I hope this explanation is clear.
Yes, it is. Thank you, sir.
Aha.
Thank you, sir.
We are done with the computation. We are done with our question. So your comment will simply be, financial risk has increased, but the business risk has reduced. As a result of the new investment, the company financial risk has increased, but the business risk has reduced. Oh, no wonder this thing was done. But we are not done. The second aspect of capital structure, because we are aware that this is new to most of us. Of course, it's new to everybody on this. This is the first time we are having financial management at skill level. So it should be new to everybody on this. Let us look at the second aspect of this. Now I've gone so far. Okay. Okay, no, I'm not. I want to discuss theories of capital structure. I want us to discuss, we stopped here at our last explanation. We want to discuss theories of capital structure. And please, as much as possible, let's try to listen. Examiner may ask you calculation here, or you may be asked theoretical question here. There are two main theories that try to explain the impact of changes in gearing on the company's cost of capital and the company's corporate value. Let me repeat that. There are two main theories that attempted to explain the impact of changes in gearing on the weighted average cost of capital and on share value. These theories are the traditional theory of capital structure, also known as net income approach. And we have the Modigliani-Miller theory, also known as net operating income approach. Let us look at the first theory, the traditional view of capital structure. This school of thought, the traditional school of thought, argues that there's an optimal level of gearing. Please, when we say gearing, it means borrowing or debt. When you use the word gearing, it means borrowing or debt finance. The traditional school of thought argues that there's an optimal level of capital structure, an optimal level of gearing for every company. This optimal level is achieved at a point of gearing where the weighted average cost of capital is minimized. The optimal level is achieved at a point of gearing, that is, at a point of borrowing, where the WACC is at minimum. Once a company achieves minimum weighted average cost of capital, then the company should stop adding debt finance to the business. Let's try to explain further. The theory is saying that it is good for companies to borrow money to finance their business. It is good to use debt finance to finance your business. By borrowing money to finance your business, the company will enjoy tax relief on interest payable. The interest payable on debt, the company will enjoy tax relief. The tax relief will be used to reduce the company's overall cost of capital. The tax relief will be used to reduce the company's overall cost of capital. Reduction in cost of capital will continue in as much as you are putting debt. The cost of capital will continue to reduce. But it will get to a point, it will get to a minimum point. Once you get to that minimum point, attempt to bring in more debt capital to the business. We shoot the cost up. So the theory is saying that borrow money to finance your business, but you must know when to stop adding debt finance to the business. Once you achieve the minimum level of WACC, then stop adding debt finance to the business. By borrowing money, that is, by financing your business with debt, automatically you have introduced financial risk to your business. Assuming you run your company on your own. You started your company with your own money. Your own money is equity finance. You started your business with your own money. Your money is equity finance. As the business grows, you require more money. You now go to borrow money. As your business is growing now, you require more finance. You now approach to borrow money. As soon as you borrow money to your business, then you have introduced gearing to your business. You have introduced debt finance to the business. And you have introduced financial risk to the business. Remember, financial risk is purely associated with debt finance. So by bringing debt finance to your business, you have introduced debt, you have introduced financial risk to your business. By introducing financial risk to your business, the shareholders will ask for more return. The shareholders will demand additional return because the risk of the business has increased now. The higher the risk, the higher the return. Hence, investor will demand additional return. As a result of this, the cost of equity will rise. Please note, that cost of equity is what we call return to equity holder. Your cost of equity will rise, but cost of debt will continue to fall. And your work will continue to fall until you get to a minimum point of work. Once you achieve minimum work, the concept is do not introduce debt finance to the business again. Stop borrowing money. Because attempt to bring in more debt finance, it means that you are putting the life of your business at risk. That is the position of the traditional school. It means that capital structure, how you choose to finance your business, will affect your cost of capital, and hence will affect your value. The traditional school says that how a company chooses to finance its business, we have impact on its cost of capital and on its corporate value. That means capital structure is relevant to company's market value. The conclusion of the traditional school was that the company capital structure will have impact on the company's value, and we have impact on the company's cost of capital. That was the first theory. The second theory is Modigliani-Miller theory. We call it M&M. Modigliani-Miller challenge the position of the traditional school. M&M challenge the position of the traditional school and argues that a company's capital structure will not have impact on the company's market value and on the company's cost of capital. M&M argues that a company's capital structure will not affect the company's corporate value and will not affect the company's cost of capital. That is, how you choose to finance your business will not affect your value. If you like, finance your business with equity, capital only. If you like, finance your business with combination of equity and debt. Or if you like, finance your business with debt capital only. Go and borrow all the money. That will not affect your corporate value. Provided there is no taxation in the economy. Their theory, M&M theory, was based on the assumption that there is no taxation in the economy. Companies are not liable to pay tax. That if you like, finance your business with equity or debt. In as much as there is no taxation, value of the two companies will be the same. And cost of capital will be the same. Because the only advantage of debt finance is tax relief on interest payable. The only advantage of debt financing is because if you use debt finance to finance your business, you are going to pay interest. By the time you pay interest, the tax authority will give you tax relief on the interest payable. The tax relief will be used to reduce your cost of capital. Reduction in your cost of capital will enhance your market value. So M&M is saying that if there is no taxation, that means whether you finance your business with equity or you finance your business with debt, you are not going to enjoy tax relief. So they supported their argument by saying that, look, if you bring in debt, when the level of gearing increases, that means there's greater proportion of cheaper debt finance in the company's capital structure. As gearing increases, cost of equity will increase. While cost of debt will continue to fall. The increase in cost of equity will be offset by reduction in the cost of debt. Hence, weighted average cost of capital remain unchanged. Just 1 minute, please. In as much as the WACC remain unchanged, value of the company will be the same. Yes, Joseph.
Good evening, sir. Hello, good evening, sir.
I don't know, but I can hardly hear you.
Can you hear me now?
Yes, go ahead.
Sir, I want to know the page where I can get this topic.
want to
Hello,
know
sir, are you
what?
there?
Yes, I'm here.
I mean the page in our material that I'll get this topic that's written now.
The page in your material, go to page 112, between 112 and 111.
Okay, sir. Thank you, sir.
Now, M&M developed formula to support their argument. Where there is no taxation, look at it. The work in an ungeared company, the work in a geared company, and the work in an ungeared company will always be the same. Look at it. Weighted average cost of capital of a geared. What is a geared company? Company financed by equity and debt will be the same as the work of an ungeared company. When we say work, I will still try to explain it as much as I could, but it's a topic under cost of capital that the second lecturer is taking you. Have you started work computation with Juan?
Not yet, sir.
Okay. So the weighted average cost of capital of a geared company is the same as the work of an ungeared company. Value of a geared company is the same as value of an ungeared company, in as much as there is no taxation. The second proposition is the cost of equity in a geared company is higher than the cost of equity in an ungeared company. I will try and demonstrate this more. The cost of equity in a geared company is higher than the cost of equity in an ungeared company. The cost of equity in a geared company is equal to the cost of equity of an ungeared company plus the financial risk premium. This formula we apply. Cost of equity of geared, KE represents cost of equity. G represents geared. Cost of equity of geared is equal to cost of equity of ungeared plus bracket cost of equity of ungeared minus cost of debt, close my bracket, value of debt divided by value of equity. I can apply this now. Let me try and let me see if I can demonstrate with illustration. Because without being told, the silent in the class does not mean they understand what you are saying.
Sir, I will not lie, it's strange.
I know. You know, I've been in lecturing for years. When I look at it, I'll just laugh. The silence in classroom does not mean they know they understood what you are saying 100%.
We are hoping by before the mid of this thing, we'll get used to the formula.
You are going to get, yes, I love that. Let me show you something. Let me try and show what we are explaining. Let me demonstrate it here. Okay. Let me use this place. Okay. We have, where's my pen now? Students say, yeah, this ICAN. Why did they bring FM again? They want to kill us. My God. Oh, God have mercy. All right. We have M and N. Without taxation. What this theory is saying is that, assuming we have two companies, we have company X, company Y. Both companies are into food manufacturing. They are in the same line of business. Company S is financed by equity capital, say 100 million. Imagine that you are the owner of company X. You are into bakery business. You are running your business with 100 million naira. Your own personal money. That is equity finance. Company Y is my company. I've introduced equity, 60 million. And I go for debt capital. No debt here. I've used debt capital in my own, 40 million. Total amount is 100 million, 100 million. Total amount. This is total value. Total value is the addition of equity and debt. Now, the first company is financed by equity only. Second company, equity and debt. M&M is saying that it does not matter how we finance our business. Two of us have the same 100 million, 100 million. The two of us have gotten 100 million for my business. You have gotten 100 million for your business. That means our value is the same. Because there is no taxation. Assuming there is tax now, my company will have enjoyed tax relief on debt. That will have increased my value. Since there is no tax, the two values should be the same. And if the two values is the same, the two costs will be the same. It now said weighted average cost of capital of a gears company. This is a gears company. Geared. This is an non-gears company. The weighted average cost of capital of a gear company is the same as the WACC of a non-gears company. Value of a geared is the same as value of a non-geared. Then the third one is cost of equity of a geared is equal to cost of equity of a non-geared minus bracket cost of equity of a non-geared. Plus, please. Minus cost of debt value of debt over value of equity. He's saying that this formula means that the cost of equity of a gears company is higher than the cost of equity of a geared company is higher than the cost of equity of an ungeared company. What is a geared company, please?
So what
A
is
gear
it?
company.
Yes.
Okay, a gear company is a company that is financed by equity and debt.
Correct. Yes, Rose, what is an ungeared company?
Ungeared company is a company that is financed only with equity.
Equity.
Correct. Now look at it. Now ask yourself, why would the cost of equity of a geared be higher than the cost of equity of an ungeared? Just 1 minute. I want to take water.
Is that a question?
Yes, it's asking a question.
Of course, the gear will be higher than on gear, because on gear will enter the whole business. Because the on gear will enter the whole project with 100 million without debt. Why the gear will enter the business with only 60 million, then finance the rest, the remaining 40 by debt.
So why would the cost of equity of geared be higher than the cost of equity of ungeared? Assuming you are asked,
no.
Explain why the cost of equity of a geared company will be higher than the cost of equity of an ungeared company. Explain.
Because I think please can you on gear, I mean, on gear will also pay interest. All right, I think that will be fine. Ask the question again, sir.
Look at it, oh. I said, look at my statement here. Cost of equity of a geared company is higher than the cost of equity of an ungeared company. That's a statement. And that statement is a statement of fact. Now the question is why?
Okay. My own opinion, I think gear company, they will need to pay interest on the debt they are using to finance their business.
Okay.
Why on gear will not need to pay any interest? They're
Okay,
just doing
that's better. I can give you 50%. Yes, Victor.
So I think for the cost of equity for the geared company, they have to pay interest, like he said, to the providers of the debt capital. And for an ungeared company, they don't have to worry about paying interest for the providers.
Sorry, I didn't get that. Sorry, please forgive me. I didn't get that.
For a geared company, they have to pay interest. They have to worry about paying interest for the providers of the debt capital.
Okay.
And in geared company, they don't worry about paying interest for the
providers. The same thing Moses said. Victor said Geared company will pay interest, while ungeared will not pay interest. You also try with 50%, but the way to respond to yes, Ogechi.
Okay, sir. I will still write on what you said, but I will just add that I don't know if it applies here, but the fact that they will have to pay interest on the debt collected means they'll be having a waiver in terms of taxation. So that will give them more return on their debt and equity than the people who use 100% equity to finance their business.
All right. Thank you. I pick that also. Is in line with what the two speakers said. But what the response will be, look at it, please. Let me move this here. Here, this company is exposed to, this company, we have business risk. Business risk. This company will have business risk and financial risk. If you invest your money in company X, you are only exposed to business risk. Your return will only be based on business risk. If you invest in company B, company Y, sorry, you are exposed to business risk and financial risk. The financial risk is because you have borrowed money. Now, that means the risk is higher in company Y compared to the risk in company X. Therefore, investor in company Y will demand higher return. Remember, the higher the risk, the higher the return. The investors in company Y will ask for higher return. Hence, the cost of equity in company Y will be higher than the cost of equity in company X because there's financial risk in company Y. The risk is higher, hence the cost will be higher. I hope that point is clear.
Yes, sir. Well noted, sir.
So, but you also try, because what is that financial risk? The risk is that if you borrow money, you have to pay interest and the principal repayments. This interest must be paid. If the company fails to pay the interest, if the borrower fails to pay the interest, and the principal repayment as at when due, then that company can be forced into liquidation.
Yes.
The lender can go to court to obtain judgments to sell your company where a company has borrowed money. There are several cases where bank will seize company's property. Bank has given loan to a company. The company cannot pay back. Bank will just go and obtain judgment to collect the company's property. That is the financial risk. All right. All right. Okay. The question is differences between business risk and financial risk. Let me take that quickly, although I explained this at the start of the business. Your business risk. This is the risk that has to do with the nature of your business. Business risk has to do with the nature of the company's business. The risk that a company may incur losses or a company may achieve low profits as a result due to the nature of the company's business. For example, look at this ICAN business we are doing. Look at this business we are doing now. This ICAN Tuition Center. We have our business risk. Risk peculiar to the nature of your business. There is the risk that some student might say, we are going to pay you at the end of the month. They will join the class. They will now tell you, please give me like 1 month. I will pay at the end of the month. At the end of the month, they tell you that they have not gotten money. Meanwhile, they have been taking lecture for 1 month. It's peculiar to the nature of our business. Some businesses, as you enter, you pay immediately. So business risk has to do with the nature of your business. We now have financial risk. Financial risk, this is the risk that has to do with debt finance. When you borrow money to finance your business, then you have financial risk. The risk that when you borrow money and you fail to pay the amount borrowed and the interest elements, then the company may be forced into liquidation. I hope it's better.
Yes, sir.
Yes, sir. Thank you.
The last aspect, I will try and take it for 5 minutes. We now have the second version of M&M. Let me use here to explain it. We have M&M, Modigliani-Miller with taxation. M&M revised their initial theory. M&M revised their initial theory of capital structure to include corporate taxation. The inclusion of corporate taxation significantly changed their conclusion. They argue that with corporate taxation, the value of a geared company will be higher than the value of an ungeared company, because the geared company will enjoy tax relief on debt capital. The tax relief will be used to reduce the company's cost of capital. Reduction in cost will increase value of the company. Hence, it is good to finance your business with debt capital and take advantage of tax relief on debt. With taxation, they amended their formula like this. Look at it. Weighted average cost of capital of a geared company is equal to weighted average cost of capital of an ungeared, brackets 1 minus value of debt multiplied by tax divided by value of equity plus value of debt. This formula means that WACC of a geared company. WACC in a geared firm is lower than WACC of an ungeared firm. He also says that value of a geared is equal to value of ungeared plus value of debt multiplied by tax. This formula means that value of a geared firm is higher than value of an ungeared firm. Ungeared firm. The last one is KEG is equal to KEU plus KEU minus KD, value of debt, bracket 1 minus tax. Yes, Victor.
Sorry, by value, you mean market value, right?
What do you say, sir?
I mean, by value, you mean market value, right?
Yes, yes. Market value, yes.
Okay.
Market value, that what it means. We have just introduced tax to everything now. If this formula is saying that cost of equity of a geared is more than cost of equity of a geared. So please, like Joseph asked, if you go back to the study pack, try to read it. Of course, for the first time, it might not be 100% clear. But as you go through it again, then, like I said, this topic I'm taking is to complement what the second lecturer is doing. You are still going to get to all these things where the one will apply calculation to it. All right, any other question? Any question, please? All right. Depending on I might take one question to apply this formula for you. I'm not sure if it will be texted, but it's better you understand how to use it than assuming that it will not be texted, because the same thing is still being done in final SFL. So maybe we are going to take next week. We take one question to address this. We now go to the next topic. All right. If there's no question, please note all the formula we have established. Please note it. We'll try and apply calculation to it next week. May God give us a better understanding. I will be checking out if there's no question.